Today, the consumers' last hurrah. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and profit news with a distinctively Australian flavour. In this week's market update, we look at the momentum in the market, which has turned positive, and that's your whole crypto, that is, starting with the US, Europe, Asia and Australia. The big economic news on Friday from the US was that real consumer spending rose in April by the most in 3 months. This helped to push the S&P 500 index to its biggest weekly gain since March. Now, at first glance, this may be seen as a sign of resilience on the part of US consumers, despite the highest inflation rates since the early 1980s. But if you look more closely, it's not as encouraging because consumers are having to dig deeper into their pockets to finance the spending, with the personal savings rate dropping below 5% for the first time since 2009. Annual inflation remains 3 times higher than the Fed's 2% target, and it helps to explain why policymakers are seen to be pressing on with half-point hikes in interest rates in coming meetings. Although inflation continued to increase in April, it was not at the same magnitude as in recent months. The Personal Consumption Expenditures Price Index, the PCE, rose 0.2%. That's the smallest gain since November 2020, after shooting up 0.9% in March. And in the 12 months through to April, the PCE price index advanced 6.3%, after jumping 6.6% in March. The annual PCE price index increase is slowing as last year's large gains dropped out of the calculation. Excluding the volatile food and energy components, the PCE price index gained 0.3%, rising by the same margin for the 3 straight months. And the so-called core PCE price index increased 4.9% year-on-year in April. That's the smallest gain since last December, after rising 5.2% in March. Again, some of the base effects are dropping out of the numbers. It was the second straight month that the rate of increase in the annual core PCE price index decelerated. But US inflation-adjusted consumer spending rose in April by the most in 3 months, indicating households were holding up in the face of persistent price pressures by dipping into savings. The Commerce Department data released on Friday showed that purchases for goods and services surged 0.7% in April from March, after adjusting for higher prices. Over the past year, only the 1.5% gain in January was bigger. Such strength might well temper talk of an imminent recession, especially because consumer spending accounts for about 2/3 of the economy. But what is concerning is that the divergence between spending and savings suggests we may be witnessing the last hurrah in the strong consumer narrative. It's not hard to imagine consumers watching their savings being whittled down at the same time that stocks and bonds are delivering heavy losses, deciding it's time to take a break from shopping for a while. JP Morgan estimates that US household wealth has plunged at least $5 trillion since the start of 2022 and could reach $9 trillion by the end of the year. And it's not as if wages are keeping up with either inflation or spending. The US Commerce Department data also showed that personal incomes rose 0.4% in April, deaccelerating from 0.5% in March and 0.6% in February. Call it defying gravity or call it denial. It's hard to imagine consumption can continue to grow faster than income forever, FHN financial economist Chris Lowe wrote in a research note. Plus, US corporate profits fell in the first quarter by the most in 2 years, and employers don't necessarily seem to be as willing to shell out big raises to keep or attract talent in a slowing economy. We've reached a level of wage inflation where employers are going to say, "I've done as much as I can," Jonas Prising, Chief Executive Officer of Manpower Group, said. "My consumers and customers aren't going to accept me passing these costs on any further, so we need to start to mitigate them." Now, it's true that while the savings rate may be down, overall savings are still at record highs, which should temper concern about the consumer. The generous social programs instituted by the US government to support the economy through the COVID-19 pandemic allowed consumers to build amazingly high cash cushions. Checkable deposits for households and non-profit organisations rose to $4.06 trillion in December from $1.16 trillion at the end of 2019, according to the Federal Reserve. The previous high for this metric before the pandemic was $1.41 trillion. Not only that, but the household debt service ratio has been near record lows since the start of the pandemic, holding comfortably below 10% and nowhere near the record peak of 13.2% in 2007 heading into the last recession. This is another reason why betting against the consumer might be foolish. The decline in the personal savings rate to lows last seen in 2008 shows consumers are making up for lost time during the pandemic, splurging not just on goods, but also on discretionary services, even as inflation takes a bite out of real income, Bloomberg Economics wrote in a research note. The problem is, consumers are taking on more debt to maintain their spending habits, though. The Fed said earlier this month that total credit rose a record $52.4 billion in March from April, after a revised $37.7 billion gain in February. The March surge was more than twice the median projection in a survey of economists. Revolving credit outstanding, which includes credit cards, jumped an unprecedented $31.4 billion. Another indicator is the University of Michigan's final May Sentiment Index, which decreased to 58.4 from a preliminary reading of 59.1, according to more data released on Friday. In April, the gauge stood at 65.2. Households turned especially pessimistic in their short and long-term outlooks for the economy. A gauge of current conditions fell to a 13-year low of 63.3, while a measure of future expectations dropped to 55.2. Consumers expect prices to rise 5.3% over the next year, holding close to a 4-decade high, and they expect prices to climb at an annual rate of 3% over the next 5 to 10 years. This recent drop was largely driven by continued negative views, therefore, on current buying conditions for houses and durables, as well as consumers' future outlook for the economy, primarily due to concerns over inflation. At the same time, consumers express less pessimism over future prospects for their personal finances than over future business conditions. Less than 1/4 of consumers expected to be worse off financially a year from now. And looking into the long term, a majority of consumers expected their financial situation would improve over the next 5 years. This share is essentially unchanged during 2022. A stable outlook for personal finance may currently support consumer spending. Still, persistently negative views of the economy may come to dominate personal factors in influencing consumer behaviour in the future. So perhaps the consumer has had a good run, thanks mainly to the rapid response by the Fed and the US government to flood the economy with cash during the pandemic, but all good things must come to an end, and this may be the beginning of a great retrenchment by consumers. An all-round healthy report on the consumer today, as incomes and spending rose, price pressures moderated, though not by much, and upward revisions to prior months show no sign of an economy on the verge of recession, according to First Trust advisors. And Oxford Economics' Lydia Bonsier said the latest personal income and spending reports provide some reassurance that the main pillar of the economy is still standing strong in the face of historic inflation and rising borrowing costs. But a bumpy road lies ahead for the US economy. Given persistent upside risks to inflation and the Fed's official aggressive policy stance, we now expect a total of 250 basis points of rate tightening this year, she said. We think the Fed is poised to raise the Fed funds rate by 50 basis points at each of the June and July meetings, before scaling back the pace of tightening to 25 basis point rate increases at the rest of the meetings for the year. So stocks rose on Friday after that data came out, while Treasury 10-year yields dropped. as the economic data pointed to cooling inflation and strength in consumer spending. That actually then suggested they needed to look for growth sectors, including tech, which helped the broader market end its longest losing streak since 1932. The Dow Jones Industrial Average gained 1.76% to 33,212. The Nasdaq was up 3.33% to 12,131, and the S&P 500 rose 2.47% to 4,158. And the LPL Financial's Ryan Detrick said that when the S&P 500 has gained more than 6% in a week, just like it did, the index has been 12.5% higher on average 6 months later, and 21.7% higher a year later. In other words, these big weeks tend to mark the start to strength, not the end of it. Well, I guess we'll see. As well as slowing inflation, data showing that consumer spending remained resilient renewed investor optimism in the consumer following mixed quarterly results from retailers. Gap reported first quarter results that missed analysts' forecasts and painted a gloomy picture for the year ahead after slashing guidance on growth. Its shares cut early day losses to jump more than 3%. Gap suffered from inventory imbalances along with having exposure to the lower income consumer, Deutsche Bank said in the note, after cutting its price target on the retailer to $12 from $17 a share. Ultra Beauty, meanwhile, raised its outlook for the full year after reporting quarterly results that topped Wall Street estimates, sending its shares more than 11% higher. We believe ULTA has set an achievable, if not beatable, guidance following a strong first quarter results, UBS said. Tech, which is also poised to snap 7 straight weeks of losses, continues to rack up gains, led by Apple up 4.08% to 149.64 and Google up 4.2% to 2,246, as well as strength in the chip stocks. Intel, for example, rose 2.46% to 44.55. And Marvell Technology reported quarterly results that beat analysts' forecasts on both the top and the bottom line, as growing demand for data centers, 5G and electric vehicles bolstered growth. Its shares jumped more than 6% to $60.82. And it's worth noting that US stock markets will be closed on Monday in observance of Memorial Day. Now, the upbeat mood was also seen across European stock markets, despite energy-heavy UK markets underperforming in the light of the UK windfall tax announcement on the sector to fund more support for households' energy bills, and also the latest exposés relating to Partygate. The DAX in Germany ended 1.62% higher at 14,462. The CAC 40 in France rose 1.64% to 6,515, while the UK's FTSE traded up just 0.27% to 7,585. And equity markets therefore posted a positive week, with the DAX, the CAC 40 and the FTSE all up more than 2% as investors sought out bargains after a series of weekly losses, while also taking comfort from Federal Reserve minutes suggesting the central bank could slow down its tightening if it sees signs that inflation is on the downward trend. Still, this positive sentiment in Europe remains fragile, with European Central Bank President Christine Lagarde pointing to a tightening monetary policy in July, even as the war in Ukraine threatens to curb economic growth within the region. In corporate news, heavily weighted BP stocks fell 1.2% and Shell stock dropped 0.7% after the UK government announced on Thursday that it would impose a 25% windfall tax on the oil and gas sector to support Britain's facing a record squeeze on living standards. Chancellor of the Exchequer, Rishi Sunak, said this package will have a minimal impact on inflation, but there are concerns that the extra spending will see historic price gains accelerate even further, causing the Bank of England to tighten monetary policy further. Elsewhere, wealth management firm Investec stock slumped 6%, while Swedish cloud computing firm Sync stock jumped more than 9%. And oil prices stabilised on Friday, hovering around a 2-month high, supported by expected demand growth at the start of the summer driving season in the US. Also propping up the market is the continued expectation that the European Commission will eventually obtain unanimous support from all 27 bloc members for its proposed new sanctions against Russia, against Hungary's opposition to date. US crude futures trade slightly higher to 115.02 a barrel after gaining 3.4% during the previous session, while the Brent contract traded higher at 115.41 after a gain of 2.7% on Thursday. Additionally, gold futures rose just 0.22% to 1,851, while the euro-US dollar traded 0.1% higher at 1.0735. Asia-Pacific stocks were also up on Friday, taking cues from both a rebound in US counterparts and the latest earnings suggesting that the US economy remains strong despite inflation. Japan's Nikkei 225 rose 0.66%, 26,791, as data released showed that the Tokyo Core Consumer Price Index, the CPI, grew 1.9% year-on-year in May 2022. Tokyo CPI grew 2.4% year-on-year, and the CPI Tokyo ex-Food and Energy Index grew 0.1% month-on-month. So the cost of living in Tokyo increased at the same pace as last month, underscoring the nation's weaker price momentum compared with global peers and offering some support for the Bank of Japan's stimulus stance. Consumer prices excluding fresh food climbed 1.9% as the impact of accelerating processed food prices was cancelled out by smaller gains in energy costs, according to the Ministry of Internal Affairs data. Economists had expected a gain of 2% for the leading indicator of the national trend. The latest Tokyo figures offers another demonstration of just how Japan's price dynamics differ from the US and Europe, where central banks are taking concrete action to bring inflation under control. The lack of acceleration in price growth suggests the nationwide trend will also struggle to gain extra traction in May, an outcome that offers support for the central bank's view that Japan is not on the verge of an upward inflation spiral. Today's figures are a reminder of the weakness in Japan's inflation dynamics and will likely weaken speculation over BOJ policy adjustment, said Toru Sihiro, senior economist at Daiwa. For the BOJ, today's figures back up their stance of continuing with easing. A sharp acceleration in price growth in April has been complicating the BOJ's messaging that it needs to continue with rock-bottom rates to support the economy and look beyond temporary cost-push inflation. As energy and food costs continue to rise, consumers are feeling the pinch. To mitigate discontent, last week Prime Minister Fumio Kishida approved an additional budget to help households and firms hit by higher prices ahead of a key summer election. Those measures included an expansion of the government's existing subsidies for capping gasoline prices. South Korea's Kospi rose 0.98% to 2638, and Hong Kong's Hang Seng jumped 2.89% to 20,697, while China's Shanghai Composite was up 0.23% to 3,132, and the US dollar yuan dropped 0.6% to 6.6986. China is attempting to balance its COVID-19 measures with the impact on the economy. China-US tensions are also up after Secretary of State Antony Blinken aimed his comments at Chinese President Xi Jinping, saying that under President Xi, the ruling Chinese Communist Party has become more repressive at home and more aggressive abroad. Now, it's interesting that global shares have now reversed 7 weeks of declines that made valuations more attractive. And yet worries about inflation and higher interest rates, China's economic outlook, and the war in Ukraine, precipitated by the Russian invasion on February 24th, all remain. We may see a little bit more stability here because we have repriced stocks so much already, iCapital chief investment strategists said. I don't know how much this move higher is going to go because I don't think the fundamentals really justify it near term. In the next 3 to 6 months, it's still going to be a constrained market environment. Now back here in Australia, Australian shares rallied on Friday, led by strong gains posted by energy and consumer discretionary stocks, which lifted the benchmark index to its second consecutive weekly advance. The S&P ASX 200 added 1.08% to 7,182 on Friday, taking its weekly gain to 0.5%. The Australian share market took a strong lead from Wall Street, where all 3 major benchmarks rose by more than 1.5%, led by a 2.7% rally by the Nasdaq. While the local technology sector climbed 1.2%, it was weighed down by shares in Appen that plunged 20.9% to $6.54 after Canadian IT services company TELUS pulled its $1.2 billion takeover offer. The CEO and chairman of Appen face pressure from investors to resign at the company's annual general meeting. Block jumped 5.9% to 117.10, and Technology One firmed 3.5% to 1043. Consumer discretionary stocks were buoyed by optimistic forecasts from retailers on Wall Street, lifting the local sector 2%. City Chic jumped 8% to $2.44, and Breville Group climbed 3.3% to 2065. Sentiment was also boosted by data from the Australian Bureau of Statistics. April retail sales rose 0.9% month on month, hitting another record level. This lifted the Australian dollar to 71.61 cents, its highest level since early May, with the currency on track to post its second straight weekly gain. Meanwhile, higher oil prices pushed energy stocks higher, with Beach Energy up 3.8% to $1.64 and Santos 1.1% higher to $8.24. Infomedia jumped 6.5% to $1.72 after US private equity firm Battery Ventures lobbed a $1.75 a share bid for the company, which now has 3 suitors on its heels. Shares in Virtus Health dropped 0.9% to $8.08 after its board recommended that BGH's takeover offer was superior to rival bidder CapVest. And all 4 major banks advanced, supporting the local market, with CBA up 1.1% to 106.63. Westpac was 0.8% higher to 24.09. National Australia Bank rose 0.4% to 31.68, and ANZ was 0.6% higher to 25.68. Macquarie was up 2.92% to $183. Finally, to crypto, which had another bad week, and it may get even weirder ahead. Bitcoin led to decline in digital assets across the whole crypto spectrum, with the world's largest token set for an 8th straight weekly loss in its longest slump since August 2011. Bitcoin fell about 1% on Friday to 28,759, buffeted by both the macro headwinds of Federal Reserve monetary tightening and the crypto-specific fallout from this month's implosion of Terra USD, a algorithmic stablecoin, which continues to weigh on digital assets, particularly those related to decentralized finance. Altogether, the crypto market has lost some $500 billion in market value so far in May. That's a 29% plunge. For a second day, cryptocurrencies declined even as risk assets, such as stocks, rose, marking a break from their recent lockstep relationship and a sign of shaky conviction that could portend a worrisome trend. The market swoon took a lot of confidence out of the asset class, Matt Maley, chief market strategist at Miller Talbach, said by email. Therefore, as investors become a little more confident about the markets in general, they're looking at other areas in which to buy in weakness. They don't want to get burned again in the cryptos. And Ether, the second largest cryptocurrency, and other altcoins linked to popular DeFi projects like Avalanche and Solana, were among the biggest decliners, down between 4 and 7% on Friday. And in the market of non-fungible tokens, even popular collections like Bored Ape, Yacht Club, and CryptoPunks are coming under pressure. Meanwhile, short interest in the first US Bitcoin futures-backed exchange-traded fund is near the highest since the fund's October 2021 inception, as investors step up bearish bets. With the reverberations from Terra's collapse hitting altcoins harder, Bitcoin now claims a larger share of the crypto sphere, accounting for 44% of the total market's value. That's the most since October, just before the latest bull market peaked, based on data from CoinGecko. But it's not as if Bitcoin has been spared. It's now down some 60% from its all-time high in November, though it has generally traded in a range of 28,000 to 30,000 US in the past couple of weeks. The biggest cryptocurrency remains below its 20, 50, and 200-day moving averages. With each moving average currently sloping lower, it's the epitome of a downtrend, Frank Caponari, a trading desk strategist at Instinet, said. There is no question that the strong correlation between cryptocurrencies and other risk assets has broken down recently as tech stocks in the US rally after weeks in the doldrums. Digital assets have largely stayed on the sidelines. Fiona Concetta, senior market analyst at City Index, said, "This is far from the decoupling that the Bitcoin bulls were looking for. I doubt this will be the end of the Bitcoin Nasdaq positive correlation. However, the concern is Bitcoin may only trace the Nasdaq when it falls. A move below $28,000 would be significant to continue the downtrend and test the year's $25,425 low. Beyond this, $20,000 is the next psychological level that comes into play. On the flip side, buyers will be looking for a move over $31,500 for a breakout to the upside and for any chance of a recovery in the price," she added. "If anything, the fact that Bitcoin is trading sideways is already a good thing," Miller Talbot-Maley said. "The longer it can stabilise, the higher the odds will be that it can gain some upside momentum. Confidence is such an important part of new assets like cryptocurrency," he said. "Until investors regain more confidence in the cryptos, they will no longer be a good risk-on, risk-off indicator." And investors looking for a respite over the long Memorial Day weekend in the US may be disappointed because liquidity has been low and could tighten further while leverage in the Bitcoin market is increasing. Sean Farrell, head of digital asset strategy at the finance research firm Fundstrat, wrote, "The macro outlook also remains unfavorable to risk assets as the Fed hikes interest rates and starts quantitative tightening," he said. "Things could get weird," Farrell said about the upcoming holiday weekend. "The combination of low liquidity, increasing leverage and tightening monetary conditions could lead to large price swings and potentially further volatility to the downside in the immediate term." Buying put protection on long crypto positions and cutting exposure to more speculative altcoins were a couple of safeguards, Farrell wrote. And by the way, Ether was down 1.38% to 1,747. But more broadly, the deepening chasm between the crypto evangelists and naysayers may never have been as stark. Last Wednesday, Andreessen Horowitz, the most prominent Silicon Valley venture capital group, made a $4.5 billion bet on what it called a golden era for cryptocurrencies, citing a massive wave of world-class talent that entered the industry in the past year. "That's why we've decided to go big," wrote Chris Dixon, a managing partner at the firm. On the same day, a once bullish investor made headlines predicting Bitcoin could fall to $8,000 from its current level of below $30,000. Bitcoin, any cryptocurrency at this point, has not really established itself as a credible institutional investment, Scott Menard, Guggenheim Partners, told Bloomberg News at the World Economic Forum in Davos. "It's really become the market of a bunch of yahoos and backwaters." Now that's quite a shift since February last year, when Menard told CNN that he could see Bitcoin, which at the time was trading around $40,000, eventually soaring to as much as $400,000 to $600,000. Bitcoin hit its peak of $69,000 last November, and it's lost more than half its value since then as investors have pulled out of riskier assets in the face of rising interest rates. Despite the crash, there were several panels around cryptocurrencies and digital money at Davos this year, not to mention a spate of crypto-linked vendors along the town's famed promenade. But establishment voices at the summit didn't waste any time disparaging the Web3 crowd. "Bitcoin may be called a coin, but it's not money," said Kristalina Georgieva, managing director of the International Monetary Fund, on day one of the event. "It's not a stable store of value." So where do we go from here? It's easy to watch crypto's day-to-day volatility, as well as fringe projects like Terra and Luna enter a death spiral and dismiss the blockchain technology and philosophy underpinning them. But the crypto faithful say that despite its problems, crypto isn't going away. For one thing, according to some experts, crypto has to confront its branding problem. The term cryptocurrency can be misleading, Marcus Satari, an analyst at digital asset brokerage Global Block, said. 99% of cryptocurrencies aren't trying to be currencies, they're trying to be assets behind those blockchain networks, he said. And I think it's only a matter of time before all businesses integrate blockchain in some form. Calls, though, of course, are growing for closer regulation, especially after the collapse of Terra USD and its sister coin Luna earlier this month. Many advocates support greater oversight, in part because it could help cryptos gain mainstream credibility. And there are estimated to be 300 million crypto users currently, and the number is doubling every year, nearly twice the historic rate of internet adoption. Even though sentiment is very, very negative at the moment, and it all seems to be doom and gloom, he says, the actual fundamentals of crypto haven't changed. To which I would add, yes, but the momentum with regard to central bank digital currencies has changed. And my expectation is that we're going to see a real tussle as more central banks consider deploying the controlled version of digital currencies, the central bank digital currency. Now, of course, how this tussle plays out will be very interesting, but it seems to me that the question of regulation and control and who actually is in charge is the real question here. And to my mind, the recent trajectory of cryptocurrencies underscores that central bankers will say, see, we told you, we need more regulation. And by the way, here is a central bank digital currency that you can trust. Watch this space. But more broadly, the markets have definitely turned up a little, but the cracks are still there, and the consumer now is the thing to watch, because if consumers do begin to hold back as they eke out their savings and consider their incomes continuing to grow only very slowly, or not at all in real terms, this could be a very important leading indicator of where the markets go next. Not to mention, of course, the China issue, the Ukraine issue, and the question of rising interest rates, which, bearing in mind that in the New Zealand market went up by 50 basis points this last week to 2%. The expectation is that the US will put them up by 50 basis points next time around. And in just over a week, Australia will also see its rates go higher still. So higher rates are definitely on the agenda. And that, I think, will be enough to turn the markets down again. But we'll see. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.